We hear a lot about the US economy, from cable news to social media, but how much of it is actually true? Today, we'll unpack 10 common misunderstandings about the US economy, from inflation to debt, from taxes to wages, so you can better understand what's hype and what's fact. 1. The national debt will bankrupt America. It's easy to look at the $34 trillion debt and feel alarmed. But government debt doesn't function like household debt. Unlike you or me, the US prints its own currency. The real danger isn't the size of the debt, it's how we manage interest rates, inflation, and long-term confidence in the dollar. 2. Printing money always causes inflation. Not always. It depends on when and how it's done. During the 2008 financial crisis and the COVID pandemic, the Federal Reserve expanded the money supply. Yet inflation stayed low for years. Why? Because demand was low and global trade kept prices in check. Context matters. 3. Raising the minimum wage kills jobs. It's a popular argument, but the data is mixed. In many states, raising wages had little to no effect on overall employment. The key factors? Regional cost of living, automation, and how businesses adjust. It's not a one-size-fits-all outcome. 4. We're heavily taxed compared to other countries. Not quite. Compared to most developed nations, the US actually has a relatively low tax-to-GDP ratio. While our system may feel complex and burdensome, many countries have higher overall tax rates, especially when it comes to healthcare and education. 5. Wall Street reflects the real economy. The stock market and the actual economy are not the same thing. The market responds to investor sentiment, earnings, and forecasts, not whether you or I have a job. Stocks can soar even during a recession, or crash in a growing economy. 6. Trade deficits are always bad. A trade deficit means we import more than we export, but it's not inherently bad. It can signal strong domestic demand, and many of those imports improve our standard of living. The real question is whether we're producing enough value at home. 7. Government spending crowds out private investment. In theory, yes. In practice, not always. During recessions, public spending often stimulates demand that the private sector isn't filling. Infrastructure, education, and healthcare can fuel, not hinder, long-term private growth. 8. Inflation is always the enemy. Some inflation is healthy. In fact, the Federal Reserve targets 2% annual inflation. It encourages spending and investment. The real problem is when inflation is too high, or too low, for too long. 9. Tax cuts always boost the economy. They can, but it depends on who benefits. Tax cuts for low and middle-income households often boost demand. Cuts for corporations or the wealthy may fuel investment, or stock buybacks. Timing, structure, and context all matter. 10. We're headed for a collapse. Doom predictions sell, but the US economy is resilient. We've recovered from wars, depressions, pandemics, and financial crises. While challenges are real, collapse is far less likely than reform, adaptation, or recalibration. Don't let fear or headlines shape your entire understanding of the economy. The truth is more nuanced, and often less dramatic than we're told. If you found this breakdown helpful, hit subscribe and share this video with someone who needs a clearer perspective.